Building Wealth with Dividend Investing Strategies for 2025. Dividend investing is a method that investors employ to produce a consistent income source from their investments. Dividend investing is primarily characterized by the acquisition of securities in companies that distribute consistent dividends to shareholders, which are payments made from the company's profits. Because it offers investors the potential for long-term growth and a consistent income stream, dividend investing is a widely used investment strategy. Investors can supplement their overall investment returns by investing in dividend-paying securities, which generate a consistent income stream in the form of dividends. Furthermore, companies that distribute dividends are perceived as more financially stable and established, which may mitigate their risk profile in comparison to those that do not. In terms of total return, dividend-paying equities have historically outperformed non-dividend-paying stocks over the long term. This is because companies that pay dividends are more profitable and exhibit more consistent earnings growth, which can result in higher stock prices and capital appreciation over time. In general, dividend investing can be an excellent method for investors to reduce portfolio risk, attain long-term growth, and generate income. In this guide, we will present an overview of common dividend investing strategies, explain how to develop a dividend investing strategy, analyze dividend stocks, and discuss the advantages and disadvantages of dividend investing. Comprehending dividend investing. A company distributes profits to its shareholders in the form of dividends. A company may elect to distribute a portion of its excess earnings to its shareholders in the form of dividends when it generates excess earnings. Dividends are typically distributed quarterly or annually as a form of compensation for shareholders' investments in the company. The size of dividend payments can vary from negligible sums to substantial portions of a company's earnings. Companies may distribute dividends in a variety of manners, contingent upon their financial circumstances and objectives. Companies typically distribute dividends through the following methods. Cash dividends are the most prevalent type of dividend payment. Typically, companies distribute a portion of their profits to shareholders in the form of cash on a quarterly or annual basis. The cash dividend is typically expressed as a fixed quantity per share or as a percentage of the company's earnings. Stock dividends. Instead of cash, companies may also distribute dividends in the form of additional shares of stock. This is referred to as an equity dividend. The dividend is typically expressed as a percentage, and the number of additional shares that a shareholder receives is typically determined by the number of shares they already own. Property dividends. Companies may distribute profits to shareholders through property dividends. This may encompass tangible assets, such as real estate or other securities, such as bonds or stocks in other companies. Special dividends. A special dividend is a one-time payment that companies may award to their shareholders in addition to their regular dividend payments. Special dividends are typically distributed when a company has surplus cash or liquidated assets, and they are not typically included in the company's standard dividend policy. In general, companies are able to determine the manner in which they distribute their dividends by considering their financial situation, cash flow requirements, and priorities for reinvesting earnings back into the business. Benefits and risks of dividend investing. Investors are presented with numerous prospective advantages through dividend investing strategies. For example, dividend-paying stocks have historically outperformed non-dividend-paying stocks in terms of total return over the long term, thereby offering investors the opportunity for long-term growth. Investment returns can be compounded over time through dividend investing, which allows investors to reinvest their dividends back into the company to acquire additional shares of stock. Dividend investing can be a viable investment strategy for investors who are pursuing income growth and a degree of stability in their portfolios. Nevertheless, it is crucial to acknowledge that not all organizations distribute dividends, and the decision to do so is ultimately up to the management team. Furthermore, the dividend amount is not guaranteed and may fluctuate from quarter to quarter. Investing in companies that pay high dividends may involve an elevated level of risk. In certain instances, shareholders demand a substantial portion of the company's profits as a result of low or even negative growth prospects, which is why a company may offer a high dividend yield. Furthermore, Income investors possess substantial ownership stakes in numerous dividend-paying organizations, particularly those that generate consistent and/or substantial dividends. Consequently, numerous of these organizations are capable of trading at exorbitant valuations. Common strategies for investing in dividends: dividend growth investing, dividend value investing, and dividend income investing are among the most prevalent dividend investing strategies. These strategies invest in a variety of dividend-paying securities, such as those of blue-chip companies, dividend aristocrats, and high-yield dividend stocks. Van Eckbol High Dividend ETF is a high dividend yield strategy that aims to replicate the Morningstar U.S. Dividend Valuation Index, which evaluates and prioritizes companies according to their dividend yield. The potential dangers associated with investing in high-yielding companies are mitigated by the index's evaluation of financial health and valuations. Companies with substantial dividend payments are the primary focus of high dividend yield strategies. These strategies typically provide higher yields than dividend growth strategies and frequently provide distinct exposures. Dividend growth strategies typically offer a combination of exposure to growth and value companies, while high dividend yield strategies typically provide value-oriented exposure. Dividend growth strategies are designed to target companies that have successfully increased their dividends over time. Consistent dividend growth is the objective of these strategies, rather than companies with high dividends, due to the implied financial stability that companies that operate in a manner that enables them to share profits with shareholders offer. Numerous investors are attracted to these strategies. Nevertheless, the practice of selecting companies based on their dividend growth history is backward-looking. In addition to selecting companies with a high dividend yield, the long-term capacity of dividend payouts is significantly influenced by forward-looking assessments of financial health. Executing your dividend investing strategy. Investors may be most effectively served by dividend payers when they identify potential indicators of trouble, such as financial health. The Van Eck Durable High Dividend ETF is designed to monitor Morningstar's U.S. Dividend Valuation Index, which assesses financial health by utilizing Morningstar's distance to default score. Distance to default is a financial health metric that evaluates the probability of bankruptcy by evaluating a company's equity market data and balance sheet strength. According to Morningstar, companies with the lowest probability of default have the lowest likelihood of future dividend cuts. The distance to default has been shown to be an effective predictor of dividend cuts. Equity income investors must prioritize their financial well-being. Purchasing shares with a high dividend yield without considering the company's capacity to maintain its dividend payments is a hazardous investment. History offers a plethora of cautionary tales of dividend traps, ranging from financial services and housing-related industries in 2008-09 to commodities and materials in 2015, and a broad array of companies that were challenged for more idiosyncratic reasons. Distance to default is a dynamic, market-driven metric that serves as an effective screening tool to assist investors in preventing the deterioration of their balance sheets. It is a tool that investors can employ to identify companies whose dividends are at risk. Companies with superior distance to default scores are more likely to maintain their dividends, as indicated by data from the previous 15 years. It has identified several companies from various sectors and regions that have subsequently reduced their dividends. Overall, dividend-paying securities continue to be advantageous investments. However, investors must never prioritize yield over long-term total return. Avoiding common dividend investing mistakes. The most prevalent error made by dividend investors is to fall prey to dividend traps. The selection of companies based on their history of dividend payments is backward-looking and fails to consider their future prospects. Furthermore, the potential for underperformance over time can result from overpaying for yield, as more investors have allocated to and bid up the prices of dividend equities. By selecting a dividend investing strategy that takes into account a company's long-term financial health and valuations, investors can circumvent these errors. In summary, dividend investing has the potential to be a potent approach for generating income and attaining long-term growth. Investors can mitigate risks and improve their portfolios by emphasizing financially secure companies that consistently pay and increase dividends. Nevertheless, it is imperative to circumvent common hazards, including overpaying for yield or falling prey to dividend traps. Investors can effectively navigate the landscape of dividend investing and accumulate enduring wealth by adopting a deliberate strategy that prioritizes financial health and valuations. If you enjoyed this video and want to see more awesome content like this, don't forget to give it a thumbs up and hit that subscribe button.